In selecting individual securities, we need to establish some methods to actually do this. And let's go through an example of the construction of what I call a spread portfolio or a hedge portfolio, which basically means there are two portfolios. One portfolio is a number of securities that you buy. And then there's another portfolio of securities that you sell. So there's kind of a long and a short. And the difference is called a spread return, or sometimes it's called a hedged return, though I prefer not to use the word hedge because there could be some risks in that particular portfolio. Hedge to me is there's no risk. So let's think about actually how to do this. And a simple way is with what I call a cross-sectional prediction regression. And let's think about doing this. That suppose that we are standing in June, and we see the returns that are realized on, say, 5,000 securities in June. What we can do is to match those securities with 5,000 attributes that are available in May, the previous month. And for example, the attribute might be the price-earnings ratio. It could be the earnings revisions that occur in May. So let's think of running a regression. We're trying to explain, or actually in this case, predict the cross-section of 5,000 stock returns in June with 5,000 earnings revisions in May. It's a linear regression. You have an intercept and a slope. And suppose it's the case that the slope is positive and significant, which means higher earnings revisions, like forecasts becoming more positive, actually leads to higher returns cross-sectionally in the next month. So this would imply immediately a portfolio strategy. What we would do is we would sort by the earnings revisions in June, so at the end of June, and select a portfolio of the highest earnings revisions, let's say the top 1,000, and that would be our buy portfolio. And then we would have another portfolio of the 1,000 lowest earnings revisions, probably negative, and that would be our sell portfolio. The 3,000 stocks in the middle we're going to ignore, and what we do is we hold that portfolio for 1 month, or perhaps longer, but for this example, let's say 1 month. And there's a return that's realized in July for the buy portfolio, a return for the sell portfolio, and we look at the difference. We'll call that the spread return. And then we repeat the analysis. In July, we've got a new set of earnings revisions. Sort by those earnings revisions. Buy the top 1,000, sell the bottom 1,000. And again, we've got a second month's return. And we can continue to do this and populate all of our historical data with this particular strategy. Now, what we actually earn here, if we're able to execute this, is a spread return. And it's often the case that the market risk, or if we just measure against the market as a whole, the market risk or the beta of these portfolios is usually close to 1. And when you take the spread, it's close to 0 in terms of market risk. So there's a number of interesting issues that arise in implementing this strategy. The first thing is that this strategy is, by construction, out of sample. So we sort in June by earnings revisions, and then we hold for July, which is outside of our data, perhaps. The other thing that we need to consider is that there's a number of subtle things that might go into our analysis. For example, suppose we do the historical analysis on the earnings revisions and find out that the spread return is 12%. And suppose that it's the case that the market return over the same period is 12%. So you might wonder, well, why don't we just buy the market? Well, there's a big difference. If we buy the market, then we're subject to the market risk. The market has got a beta of 1. Our portfolio has got a beta of 0. The excess return of our strategy, or the abnormal return, risk-adjusted, is 12%. The risk-adjusted return of investing in the market is 0. So then there's many possibilities here. It could be that the return on our long portfolio is 18%. The return of our short portfolio is 6%. And that kind of brackets the market. It's even possible that the return of our long portfolio is, let's say, 30%, and the short portfolio is 18%, both of them above the market. In that case, is it wise to buy the long portfolio and sell the portfolio of the lowest earnings revisions? Well, as an alternative, and that alternative is to buy the highest earnings revisions, and then you could lay off the risk by selling the index futures. And that would deliver a larger spread, a spread of 18%. It is possible that when you look at these individual attributes that you have a nonlinear relation, that the endpoints, so the lowest and the highest values of these attributes tend to produce higher returns, and the stuff in the middle, lower returns. And it's possible you could use a nonlinear type of analysis to capture this. So there's a lot of subtle things that go into stock selection and how you structure the portfolios. The most important thing to me in evaluating the ability of certain characteristics to spread returns, and by spreading returns I mean the difference between the buy portfolio and the sell portfolio. The most important thing to me is not just the spread, but the consistency of the spread. So instead of just looking at the average spread over our sample, maybe it's 12%. Look at the spread year by year. Maybe it's the case that there's a huge spread in the very first year of analysis, and then the spread goes away or goes negative by the most recent year. And you look at the average analysis and it says, oh, well, 12% spread, that looks pretty good. Well, that doesn't impress me too much because it's going away or it's gone away. And if I start investing based upon that one strategy, I could be losing money going out of sample. So consistency is extremely important here. The other thing to realize, and we'll talk more about this, is that it's unlikely that any single attribute is going to lead to a strategy that delivers a positive alpha on a risk-adjusted basis, like adjusting for more than the market. It's obvious to me that stock selection is a multivariate task. We've got many different variables that we have to look at, and we have to combine in a very smart way. And that, of course, will be the subject of a much more detailed discussion.